Stop for a second. I mean it. Put your phone down right now and turn off those relentless market alerts that have been dictating your heart rate all morning. I'm not suggesting you walk away forever, but just long enough to clear the fog and think for yourself without the constant, high-frequency noise of the digital ticker. Now, open YouTube and take a hard look at exactly what is being sold to you in this current cycle. You see the same recycled thumbnails, the same frantic faces, and the exact same promises of effortless wealth that we see at every major peak. Two letters are absolutely everywhere: AI. They are calling it a once-in-a-century super cycle that justifies any price, no matter how disconnected from reality. They tell you NVIDIA is going to the moon and that Microsoft is the only safe harbor left in a crumbling world. The tone across the board is always the same: urgent, absolutely certain, and allowing no room for even a whisper of doubt. That is the specific part that should start to bother you deeply. Because when every single person sounds as certain at the exact same moment, it usually means they're selling you a manufactured feeling, not objective information. When you buy into a collective feeling, you stop checking the receipt. You stop asking what you are actually paying for or what specific economic conditions must remain true for this fairy tale to keep moving forward. This is precisely how retail investors are transformed into exit liquidity for the institutional giants who are already looking for the door. In this game, if you cannot look around the room and identify who the sucker is, it is almost certainly you. We are currently witnessing a historic and dangerous concentration of capital into just a handful of technology names. What used to be a broad group is narrowing into a relentless few. This is not a sign of a healthy market. It is a narrowing funnel that suggests the very foundation is cracking under the weight of its own expectation. It is like building a massive skyscraper on a single, thinning pillar. It looks impressive to the crowd, but the underlying physics are working against its stability every single hour. When market breadth shrinks while prices hit all-time records, you are looking at a house of cards, not a fortress. You have heard the old quote about the taxi driver giving stock tips being a sign of the end. Let me update that for our digital, hyper-connected age, when every influencer on your feed, every family member at dinner, and even your barber starts pitching the same AI trade with unshakable, religious confidence, it is not mass adoption. It is dangerous, suffocating crowding. Is the sound of a room getting way too full while the exit door stays the exact same size it has always been? The technology might be very real, but the current price is no longer reflecting utility or earnings. It is reflecting a collective, feverish dream that is becoming far too expensive for the average person to maintain. The glowing screen in your palm says wealth is expanding, but the day-to-day reality you see in the streets says pressure is mounting. When these two realities drift this far apart for this long, something eventually snaps with violent force. It does not always happen today or tomorrow, but the tension is building in the shadows of the economy until it becomes impossible to ignore. This is why institutional warnings, like the recent notes from major research firms, are finally getting serious attention from the smart money. It is not because one shop is always right. They're often wrong. But because when massive institutions start putting ugly, realistic scenarios on paper, it fundamentally shifts how the big capital behaves. They stop chasing the imaginary upside and start calculating the exact distance to the nearest exit. They're now openly discussing a deep drawdown, a major move lower in the S&P 500 toward levels we haven't seen in years, potentially down to the low 4,000s. Let's be precise here. This is a scenario based on shifting liquidity, not a guaranteed prophecy. Markets do not follow scripts, but these scenarios matter immensely because big money reacts to them by changing its posture. When serious money sees systemic risk on the horizon, it does not wait for a mainstream headline to confirm its fears for the public. It adjusts exposure quietly. It trims its most bloated, overvalued positions while the retail crowd is still buying the dip. It hedges heavily against the downside. And when enough of these massive players move at once, the very nature of market liquidity changes. The market stops feeling like a safe, bouncy trampoline and starts feeling like a fragile, grease trap door. Right now, the market feels like pure speed. It feels exciting, like momentum is finally on your side and the gains will never end. But you must remember that speed is never the same thing as safety. Speed is only safe when the road ahead is perfectly straight, well-paved, and clear of obstacles. However, the road always bends when the consumer finally breaks under the relentless, compounding weight of inflation and mounting debt. The average consumer is the real engine of this entire economy, not a handful of tech companies in Silicon Valley. If the consumer slows down, even by a tiny fraction, corporate earnings feel that impact instantly across every single sector from retail to energy. If earnings get questioned, those sky-high, aggressive valuations lose their justification overnight. And if the valuations are questioned, the entire crowd starts looking for the exit at the exact same moment. This is the ultimate danger of a crowded trade where everyone mistakenly believes they will be the first one through the door when the lights go out. So, what exactly should you be watching while everyone else is distracted by the flashy AI headlines? I keep my focus on 3 specific buckets of systemic risk that the mainstream often ignores. Bucket number 1 is household stress. When more and more essential spending is being pushed onto credit cards at record high, predatory interest rates, the entire economic system becomes incredibly fragile. People can keep spending for a while by essentially burning through their future earnings power, but eventually they hit a hard wall. When that wall is hit, the decline in consumer spending is never a slow, gradual curve. It is a sharp, sudden cliff that catches the entire market off guard. Bucket number 2 is the trend in delinquencies. When late payments on auto loans and credit cards start to rise consistently month after month, it is not just a vague vibe or a statistical anomaly. It is a direct, measurable hit to the economy's cash flow. The exact percentage does not have to match a previous historic crisis for it to be a serious, terminal problem today. The direction of the trend and the accelerating pressure are what truly matter. Bucket number 3 is savings behavior. Personal savings serve as the essential shock absorber for the entire economy. When households are forced to burn through that absorber just to maintain their current, basic lifestyle, the economy might look fine on the surface, but underneath, the ability to handle any sudden shock, layoff, or policy change is completely gone. Now, overlay these 3 buckets of growing stress with a stock market that is currently priced as if everything will go perfectly forever without a single hiccup. Perfection is the most expensive and dangerous price in the world to pay. That is exactly when the risk becomes asymmetric. The potential for more gains is mathematically limited, while the potential downside is a massive, life-changing crater. This is where the AI narrative becomes truly dangerous for your portfolio. Not because the technology itself is a lie. AI will indeed change how we work, but because narratives give people a psychological excuse to ignore the messy, broken parts of the underlying data. People cling to a clean, simple story when the reality is mixed, confusing, and painful. The cleaner and simpler the story is, the easier it becomes for you to overpay for it without a second thought. During these volatile periods, narratives stop being about technology or innovation and start being about emotional safety. People are buying tech stocks because they are terrified of the inflation story and the government debt story. They're using these high-flying names as a bunker to hide in. But a bunker built on a sky-high valuation is nothing more than a house of cards waiting for the wind to shift. When a narrative finally breaks, the bunker becomes a trap. It is also vital to realize that policy changes hit the average consumer just as hard as inflation does, often with a lag that fools the experts. Take tariffs as a primary example. Some economic analyses estimate that they can function as a massive, hidden household tax, potentially costing the average family over $1,000 every single year. This adds even more pressure to the consumer engine we keep talking about. If the consumer is squeezed from both sides, high costs and high debt, spending will eventually soften. If spending softens, earnings expectations become incredibly vulnerable to a massive downward revision. This is the true, raw meaning of divergence. It is not just a fancy economic term. It is the physical gap between market optimism and the harsh reality inside the average household kitchen. Massive markets usually do not start with one single dramatic headline that everyone sees coming. They start with the boring, quiet mechanics of the market. A few earnings misses here, a small credit pocket tightening there, and the overall breadth of the market beginning to weaken until only 2 or 3 stocks are holding up the entire index. Then, liquidity becomes incredibly picky about what it will support. At that point, selling stops being an optional strategy for the big players. It becomes a forced mechanical requirement. Margin calls, mandatory rebalancing, and risk management models all force reductions at the worst possible time, regardless of the long-term story. This is how markets actually fall. It is not always about panic or emotion. It is about forced sellers who have no choice but to hit the bid at any price just to survive another day. So, what do you actually do with this perspective? First, do not panic. Panic is the fastest way to make a permanent, devastating decision during a temporary moment of extreme volatility. Second, you must learn to think in layers. Cash is not just a static asset or a lack of imagination. Cash is pure, unadulterated optionality. It is the power to act decisively when everyone else is being forced to react in a blind panic. It gives you time, it gives you choices, and it gives you the ability to buy great assets without needing the market to agree with you by tomorrow morning. Third, separate the short-term hype exposure from real economy resilience. Look at infrastructure, energy systems, and the boring materials that keep the lights on in the real world. These sectors do not have the same excitement as AI, but they have the durability to survive the snap. If a big drawdown comes, it will not just be a crash. It will be a historic transfer of wealth from the impatient and the crowded to the prepared and the patient. Decide, right now, which side of that transfer you want to be on when the music finally stops.